Hey, good morning, everyone. Marty Missouri here, 8th of August, 2019. Going to spend just a few minutes with you on the blog, talk to you about what I'm seeing in here. We're seeing a really nice bounce this morning after the big sell-off on Monday. Market kind of battling with these levels in here Tuesday and Wednesday, and then gapping higher this morning and testing what I think is going to be a tough nut to crack right here at the top of this gap they got here on Monday, this gap lower. Now, we're just going to focus on the short-term stuff, really zeroing in. Here we are, this wedge pattern that I've been showing you, told you that it was very likely that we break down below. This bounce right here, for a lot of reasons, shouldn't be a surprise. Number one, this trajectory is just unsustainable. You know that at some point you're going to get a move sideways, a bounce up, and so forth, and then we're going to begin to look at other things and engage our short-term expectations. We also had an oversold level down in here. That's what the RSI was telling us. Short-term traders were definitely jumping on that once we got below that yellow line right there below 30 on the RSI. And so we're still low. We're still close to oversold levels, so there's certainly nothing frothy yet about this bounce higher. A lot of technicians will trade these gaps. In fact, it's interesting how often gaps are filled. One technical analyst who I used to follow said that 90% of all gaps get filled. So in fact, just pointed this here, we had a nice gap up, and you can see that ultimately we came back and filled that gap back in here. Right here, had a nice gap up, came back ultimately and just filled that gap, right back in here. So you can go on, and it's been my observation that it's not something that I would trade, but yeah, it is something that I can look at and gauge short-term expectations. So don't be surprised if right in here today, looks like we may actually get there. Right in here, whatever that is, 29.15, 29.16. That the S&P, runs into some headwinds, and we are virtually there right now. Now, if we get some good news, or if we've gotten some news already that I don't know about, no doubt we could pierce through here and we'd be talking about higher levels. At some point, of course, as this continues, and suddenly I'm going to be short-term bullish because then we have positive breakouts with momentum following. Right now, no, that's not where we want to be. Right now, I would say there is probably a raft of people getting ready to sell this level right here. No doubt some shorts will accumulate if they're not already there. Of course, if we break through that, then of course shorts will have to cover, and that would of course exacerbate somewhat of an upside move. Okay, so I promised coming this often at you that I would mix things up. So I'm going to zoom out a little bit, and we're going to look at some retracement levels. Big sell-offs tend to go through periods of what we call retracements, specifically Fibonacci retracements. Centuries-old mathematical theory that things tend to move in certain ways. They go through waves. We get movements in one direction, a wave back, or retracement in another. Now I can tell you for sure that technicians pay very close attention to three levels of retracement. So for example, back here before that big correction last fall, we came down, we topped out in October, came back, bottomed right here, 38.2, missed that one a bit, 50, and then 61.8. Those are the key retracement levels, primarily 50 is the one I think to pay the most attention to, but all three of these tend to see action right at those levels. So you notice that as we bounced off of here, we hesitated right here at the 38.2 retracement, blew through the 50, although if you looked at a minute chart, I'll bet this day there was just a lot of action right on that line. You can see that we gapped up and then held right there at that 50% retracement, and then lost it finally at the 61.8. Came back. Anxious buyers would not allow this to get tested, this particular bottom, but anxious sellers right here at the 50% retracement were not going to allow it to go any further. And ultimately the sellers won, and we had the worst December since 1931. Okay, so let's go ahead and let's move our retracement out to the next correction or next sell-off that we actually felt, and that happened back here in May. So we peaked right here toward the beginning of May, came off of that, and bottomed for a moment right here. Here's your 38.2. Here's your 50, and then here's your 61.8% retracement. So notice in this instance, it was the 50 that held. Came back, nice rally. Looks familiar, doesn't it? Big red candle, sideways action, nice move, and then a gap higher, and then stopped right here at the 50% retracement and came down. And we ended up, with again, a noticeable 7+% on an intraday basis correction there in May. Okay, so here we are today. Here we are with our current sell-off. Here we'll go to Monday's bottom, move this up to the top where things rolled over, and we'll zoom in again on this one and do a little work and see what we get. Okay, so again, we bottomed here, steep sell-off for a few days. Came out of it, had this nice gap. We had somewhat of a gap here at the open. And as I said, testing right now, boy, as I speak, we're testing the bottom of that gap. I suspect we're going to struggle here a bit. And just above that, lo and behold, is our 50% retracement. And then the 61.2. And right here, we'll see how today unfolds. Be interesting to see if this right at 2,900, I'd look at that. If today is going to fail and it fails below 2,900, that's not going to be a real good sign for the next few days. If it holds up in here, what is actually the top of the gap here, and then up through this 50% retracement, well, then we can have a conversation of maybe a legitimate upside breakout. As you know, folks, I'm skeptical in here because of the underlying fundamental pain and what the rhetoric is sounding like of late. So it's going to take something, I think, real positive on the trade front. But anyway, that's a lecture for another day. So today, again, folks, we got a nice bounce. You can see we're testing these levels, coming off of it just a little bit here, top of this gap. Fibonacci retracements, which I've shown you, just the last three sell-offs can be important things to look at. So right now, this is a very normal bounce after a steep drop. We should not let the pigeons loose just yet and start throwing parties that this is over. My best guess is that it isn't, and we'll see this thing reverse and turn lower, but I could very well be surprised. Of course, I'd be happy to be surprised. If I had $1 for every time I've been surprised this way over the last 35 years, I'd have pocketfuls of dollars right now. So anyway, I will leave it there. Stay tuned. Be back with much more. If you didn't read my log entry this morning, I think that's an important read. Thanks as always for watching and listening. Talk to you again very soon. Bye-bye.